Welcome to the channel. Dividends. It's a term that gets tossed around a lot in investing circles, but why are investors absolutely obsessed with dividend policies? And more importantly, why should you be too? If you're looking for ways to build a reliable income stream from your investments, understanding dividend policies could be the key to unlocking consistent, long-term financial growth. Let's start with the basics. Dividends are payments made by companies to their shareholders, usually out of their profits. These payments can be a game changer, providing you with a steady stream of income without having to sell any of your shares. Now, you might be thinking, why should I care about dividends? Don't I just want my stocks to grow in value? While stock price appreciation is important, dividends offer something even more powerful: consistent cash flow, regardless of the market's ups and downs. Here's why dividends matter: they offer stability. Dividend-paying stocks tend to be less volatile than their non-dividend counterparts, especially during market downturns. While growth stocks can fluctuate wildly, dividend-paying stocks offer investors a cushion and reliable income even when the market isn't cooperating. Now, not all dividend policies are created equal. That's why investors are so focused on the specific policies companies adopt. A company's dividend policy tells you how committed they are to returning profits to shareholders. And here's where the obsession comes in: some companies pay high dividends, while others grow their dividends over time. Which one is better? High dividend companies are great for generating immediate income, but companies that increase their dividend payouts year after year are often seen as more sustainable, long-term investments. Why? Because consistently growing dividends signal financial health and stability. It's a sign that a company is not only profitable but also confident in its future prospects. Let's dive deeper. Companies that grow their dividends year after year often have strong cash flow, a reliable business model, and effective management. This kind of growth doesn't happen by accident. It's a deliberate strategy, and it's a key indicator of financial strength. For example, some blue-chip companies have been increasing their dividends for decades, building a reputation for stability and reliability. Take companies like Coca-Cola, Johnson Johnson, or Procter & Gamble. These companies are known for the consistent dividend increases. Their dividends aren't just a way to reward shareholders, they're a way to attract long-term investors who are looking for steady growth and security in their portfolios. Here's another reason why investors love dividends: the power of reinvestment. When you reinvest your dividends, you're essentially buying more shares without having to add more cash to your account. Over time, this compounding effect can significantly boost your returns. It's like planting seeds and watching your wealth grow over the long term. Even if you're not actively buying more shares, reinvesting those dividends allows you to accumulate more stock, leading to greater returns. This process, known as dividend reinvestment, can transform a modest investment into a substantial one, especially when combined with the power of time. But let's not forget the importance of sustainability. A company's dividend payout ratio, the percentage of its profits paid out as dividends, is a crucial metric for understanding whether the dividend is likely to continue. A payout ratio that's too high could indicate that the company is paying out more than it can afford, putting future payouts at risk. Investors should be looking for companies with a payout ratio that's manageable. Ideally, a payout ratio between 40% and 60% indicates that the company is paying out a healthy portion of profits, while still retaining enough to reinvest in its growth. Anything higher could be a warning sign that the dividend may not be sustainable in the long term. So, why are investors obsessed with dividend policies? Because dividends are a powerful tool for building a steady income stream, protecting against market volatility, and compounding wealth over time. But it's not just about the dividend amount, it's about consistency, growth, and sustainability. By focusing on companies with strong, growing dividends, you can create a portfolio that not only generates income but also increases in value over time. Whether you're looking for a passive income source or a reliable long-term investment, dividends are the key to building wealth safely and steadily.